In this video, we break down the real-world landscape of market participants, from high-frequency trading firms operating in microseconds to sovereign wealth funds investing over decades. By walking through strategy types and the kinds of players behind them, we uncover how edge is created, where competition is toughest, and why costs vary dramatically across time horizons. Welcome to Alpha Quant Solutions, the platform where markets meet science and engineering to deliver your investment edge. To start, we would like to introduce what we call the trinity of market behavior, or in other words, the three time frames that define financial markets. So, for the first time frame, shown here in yellow, we would like to identify it as stretching from milliseconds to a couple of minutes in terms of time horizon. And we call it here the microstructure zone because basically here it's all about order book dynamics, market liquidity, latency and speed, precision, and also high performance hardware and IT infrastructure. The second time frame, shown here in red, stretches from a couple of minutes to a couple of weeks, and we would like to call it the trader's battleground zone. This is a zone where short-term to medium-term trend and mean reversion strategies live. This is also a zone where we have the highest diversity in trading strategies, but also probably the most competitive zone. This is where all the retail traders, discretionary trading happens, but also where all the smart quant hedge funds are living. So it's a highly competitive environment. The third time frame, shown here in green, stretches from a couple of weeks to decades, and we would like to call it the strategic investment zone. And here it's all about long-term capital allocation and macro and regime-based asset allocation. Quick disclaimers: we do not give investment or financial advice. We are only sharing our personal opinions. Now we will go through our table by looking at each row separately. So we'll start with the time horizon from milliseconds to seconds. And this is the realm of high-frequency trading firms. These players run ultra-optimized algorithms, which are co-located next to exchange servers. And their strategies exploit microstructure inefficiencies, in fact. So, like bid-ask spreads or arbitrage across exchanges or price imbalances that last milliseconds or even microseconds. So essentially here, the traders behind these strategies are not staring at charts or at screens. They are engineers and quants focused on latency, hardware optimization, and market microstructure modeling. And in fact, their competitive edge is execution speed and really not so much forecasting ability. Now to the second row, in terms of time horizon from seconds to a couple of minutes. And here you can think of someone taking dozens or hundreds of trades a day, often holding for just seconds or a minute or a few minutes perhaps. And the aim is to profit from tiny movements in price by buying on the bid and selling on the ask, or by riding so-called micro momentum bursts. So essentially, traders here rely on highly responsive models and systems. And this is the so-called scalping arena. And at this time scale, from seconds to minutes, scalping is typically done by flow traders, market makers, and independent scalpers. And finally, success is here about precision, reaction speed, and liquidity awareness, and not so much about direction over longer time frames. Moving to the next row. So now we are dealing with strategies in terms of time horizon from a few minutes to a few hours. And this is where active day traders, retail momentum traders, and also sophisticated proprietary intraday desks operate. This is a highly competitive environment, and the goal is here either to catch directional moves or sharp reversals, so mean reversion strategies, and both to do that within the same trading day. So here, typically traders would tend to blend technical analysis metrics with some advanced pattern recognition schemes. And the strategies, they tend to be fast and indeed quite tactical in the sense that all positions are opened and closed before the market closes. So this is where typically we would find all traders that are on platforms like MetaTrader 4, MetaTrader 5, also programming in the MQL language. So this is indeed a very, again, highly competitive environment. Moving now to the next row, and now we are dealing with time horizons from a few hours to a few days. And this is the typical realm of the so-called swing traders. So they tend to hold positions that are long enough to catch mini trends and mini reversals, but short enough to avoid deep macro exposure. So the group of participants here include retail traders, also thematic traders, as well as hedge funds running short-term tactical strategies. And they often trade around, for instance, earning events, analyst upgrades, short-lived sector momentum, or other volatility bursts. So these strategies are still sensitive to timing and news flow, but are much less reactive than intraday trading strategies. The next row spans a period going from a couple of days to a couple of weeks. And here we find discretionary hedge funds and non-HFT quant funds, and also so-called multi-strategy portfolio managers. And all of these are basically firms running short-term trend following systems, event-driven plays, or mean reverting statistical arbitrage models. So here, as an example, a fund might go long a stock ahead of an expected acquisition, or do some pair trades between correlated equities. Other examples might be, for instance, to follow short-term momentum in commodities or foreign exchange rates or equities over several days. So typically here, the players would tend to use structured processes, for instance, also factor-based models, coupled with rigorous backtesting, and often would be mixing systematic entries with discretionary overlays. To conclude, I would say, like the other two traders' battleground zones, this row, also spanning from a few days to a few weeks, is both highly competitive and also rich in strategy diversity. Moving now to the strategic investment zone, with the first row being strategies that span from a few weeks to a few months in terms of time horizons. And here, this is the domain of commodity trading advisors and global macro funds. And these tend to ride medium-term trends across asset classes. So we may think of, for instance, managers who go long commodities during inflationary cycles, or take long equities positions during risk-on regimes. These strategies rely heavily on price-based systems like moving averages, breakout models, or macro indicators. These strategies tend to be slower, it requires patience, and are often very diversified. So trends, in this case, trends are held through noise, with risk management focused primarily on capturing larger moves rather than avoiding every drawdown. Moving now to the next row within the strategic investment zone. So now we are dealing with strategies spanning from a few months to a few years in terms of time horizon. And what can we say about this row is that in this case, asset managers, pension funds, and large institutions operate in this horizon by building portfolios around slow moving and structural themes, like, for instance, the global energy transition, the rise of AI, artificial intelligence, or shifts in geopolitical power. Other examples, for instance, might include a manager that might overweight emerging markets to capture demographic tailwinds or commit capital to green infrastructure as a multi-year bet, for instance. So, what else can we say about this type of strategies? Well, these positions, while they might be held for many years, what we do see is that the entry points can still be driven by quantitative models to filter out the short term volatility and also to identify when valuation, momentum, and macro indicators align in order to give a high probability setup. What else can we also say? Well, we can say that rebalancing is infrequent. So it happens perhaps twice a year or once a year, so annually. But the signal processing behind each allocation decision can be very sophisticated by combining economic data with factor models and also with a range of other quantitative models and statistical tools and structural trend analysis as well. So, summarizing, the goal here is not about rapid reaction, but much more about long term capital appreciation and diversification by entering positions only when the data points to durable and long term alpha. Now to the far end of the time horizon. So now we are dealing with strategies that span time periods ranging from a few years to a few decades. And here we really find institutions like sovereign wealth funds, endowments, and long horizon retirement plans. Their capital is often allocated with decades long objectives in mind. For example, from generational wealth preservation to funding education or safeguarding national reserves. Their strategies often involve structural tilts between equities, bonds, real estate, and private equity. And they are also often guided by models that incorporate long term return expectations while also including a range of additional metrics like, for instance, inflation sensitivity or other global economic market shifts indicators. So here, typically, portfolio managers act when long-term data and long-term structural analysis indicate significant market shifts, such as a reversal in globalization trends, for example. So really, in summary, here, portfolio managers, basically, they make their most significant allocation moves when the structural and long-term conditions change. And really, they do not react in response to short-term noise or short-term volatility fluctuations. Quick interruption. If you like the content, don't forget to subscribe and share the video with your network. Now let's move on and analyze market efficiency as a function of timescale. And in the yellow area, so between milliseconds and minutes in terms of time horizon, what we can say is that since the emergence of electronic markets in 2005, essentially high frequency trading or HFT has increasingly dominated here. And this has resulted in a shrinking of the inefficiencies to sub-second timescales. So for most, let's say, market participants, this is not a region where we can compete unless we have top-notch hardware infrastructure, IT infrastructure, and data availability and top-notch data quality also. Next, we move now to the time horizons shown in red. So these three rows that span strategies going from a few minutes to a few weeks. And here it has been shown by Professor Quant in his seminal paper of 2001, a quantitative finance paper, titled Empirical Properties of Asset Returns, Stylized Facts and Statistical Issues, that in these time horizons, then there is absence of linear autocorrelation of price returns. So this means that all the traditional tools that we know from technical analysis, so metrics like moving averages, MACD, momentum metrics, rate of change indicators, Bollinger Bands, and linear regressions, essentially all of these tools just reflect noise, and they cannot help us to consistently extract alpha. So as a reference, here is the 2001 quant finance paper we were referring to. And let's go back to page 8, where Professor Ramakant says that the absence of significant and linear correlation in price increments and asset returns is often cited as a support for the efficient market hypothesis. And he explains that basically the absence of correlation is intuitively easy to understand. If price changes exhibit significant correlation, then this correlation may be used to conceive a simple strategy with positive expected earnings. And hence, such strategies, termed statistical arbitrage, will therefore tend to reduce correlation except for very short timescales, which represent the time the market takes to react to new information. This correlation type is typically several minutes for organized future markets and even shorter for foreign exchange markets. Now, he also refers to Professor Mandelbrot, which also stated that this arbitrage tends to widen the spectrum of price changes. So basically, the mere effect of trading these correlation basically would remove them and really replace all of this alpha by white noise. So it also states, as we mentioned, that this property implies that traditional tools, are useless. And then he also says that the absence of autocorrelation does not seem to hold systematically when the timescale data is increased, so beyond weekly and monthly, then we do see again some autocorrelation in price returns. Going back to our chart, this is also why we here show that once the time horizon starts to go from weeks, months, and beyond, then we also state here, as Professor Ramakant stated, that linear autocorrelation is again observed. Before also going a bit further, in the green area, one additional comment about this red zone. So we stated, that there is absence of linear autocorrelation of price returns. This is because of basically it's a very highly competitive environment. And this is why it's very hard to find alpha based on linear metrics. However, this does not imply or does not say anything about the absence or presence of nonlinear autocorrelation of price returns. So basically, here it could very well be the case that there is autocorrelation of nonlinear metrics of price returns. So let's say nonlinear filters, or even volatility modeling, volatility metrics, or even the use of potentially machine learning models. So if we were to use these nonlinear indicators and models and metrics, then we could be in a position to find actually some alpha. Now, in this strategic investment zone, which spans strategies having a time horizon from weeks to decades, what Professor Mandelbrot also explained in his inspirational book, The Misbehavior of Markets, is that we also see long-range memory in autocorrelation of nonlinear functions of price returns. And I'm just going to show you a page of that book. So this is the book by the late Professor Benoit Mandelbrot that I refer to in the slides, The Misbehavior of Markets. In chapter 10 of the book, Professor Mandelbrot defines the Noah-Joseph and Markot bubbles. So here, Professor Mandelbrot mentions the two dual forms of wild variability, and both are inspired by the Bible. The first one being the Noah effect, which refers to catastrophic but transient market conditions. And the second one being the Joseph effect, that actually is of interest to us here, which refers to long-range or long-term memory through which the past continues to influence the random fluctuations of the present. Coming back to the three zones we previously identified, so the microstructure zone here in yellow, the trader's battleground in red, and the strategic investment zone in green. What else can we say in terms of trading edge, competition, as a function of time horizon? Well, we can say that if we want to compete in the time horizon spanning the milliseconds to the minutes, then this will require ultra-low latency infrastructure and ultra-accurate and high-frequency data. Also, success demands real-time reaction, excellent execution, and deep understanding of order flow. Finally, in this time zone, the margins are razor thin. Next, we move to the trader's battleground zone, which is shown here in red. And again, this spans strategies going from a few minutes to a few weeks. And it's a very crowded space because this is where we will find most of the day traders, the active retail traders, but also most of the short-term hedge funds, discretionary hedge funds, and quant funds. So what can we say about strategies in this time period? Well, they tend to be increasingly crowded and suffer from diminishing alpha. So it is precisely this highly crowded space and the result of the competition that results in the so-called efficient market hypothesis, and primarily in this time period. What else can we say is that the competition is also very tough in terms of intellectual firepower and capital efficiency. So here, if you're trading in these time frames, then you're competing against trading firms and quant firms that employ, very smart people, often with a PhD degree in hard science, math, physics, or statistics. So it's really this is why I call it the trader's battleground zone. This is a highly competitive space to be playing the markets. The third and final area is shown here in green, relates to strategies spanning from a few weeks to a few decades. And this is what we refer to as the strategic investment zone. And here it's all about long-term investing. And the edge comes from identifying structural market patterns and acting only when the data signals long-term alpha opportunities with high probability. So in essence, this is reminiscent of a buy and hold strategy, but we will only enter the markets once the probability of success is really very high. Quick interruption. If you like the content, don't forget to subscribe and share the video with your network. Next, let's analyze how trading cost shifts across time horizon. And to do that, we will first classify our strategy in terms of ultra short-term ones with the strategies shown in yellow from milliseconds to minutes, the short-term strategies from minutes to weeks shown in red, and the green ones for the long-term strategies from weeks to decades. And what we can say here, we can group the first two types, so the yellow and the red ones. We'll say that these strategies in general tend to face higher costs compared to the long-term strategies. First, due to the high turnover. So every time we enter or exit the market, then we have to pay a transaction fee, and that adds up eventually. When we have many trades after some time, then we'll see the penalties on the return. But also because of tighter bid-ask spreads in general, also a cost due to market impact. Every time we enter or exit the market, we do impact the price. And finally, also there is the cost of expensive IT infrastructure and hardware, especially for market participants that are located here in the yellow area. On the other hand, the long-term strategies, they tend to have low turnover and hence are cost-efficient strategies, which are modeled after the buy and hold, with the difference that they are only activated when the edge is strong, so when there is a high probability of success. And indeed, this strategic investment zone is exactly where we have positioned our company, Alpha Quant Solutions, to capture long-term alpha. And we do this using our quantitative investing dashboard. Essentially, the visuals of our platform allow us to derive long-term and rule-based strategies that mimic buy and hold. But the difference is that we will only enter the market when the odds favor big gains and limited losses. Finally, if you are interested to see how we have used algorithmic trading to generate long-term alpha, then please have a look at one of these previous videos on our YouTube channel. Thank you for watching, and until next time.